Hello and welcome everybody. Hello, thank you for being with us here today. My name is Walid Koudmani. Thank you for being with us. I am the market analyst for XTB. We're gonna do a quick audio video check before we start just to make sure that everybody can hear me. Everybody is on, can see the screen. So if you could reply in the chat, then I'll be able to proceed. Thank you to everybody who is here with us today. It's a very special episode. We have, of course, a focus on commodities. So it's commodity special. One of my favorite topics, very interesting because it's very correlated to what happens in the world. Hello, business consultant. Thank you for being here with us. So, yep, everything is fine. Thank you, Phil. Okay, perfect. Let's just give a couple of maybe a minute for everybody to join, and then we'll start with the video and the webinar. And so the way we're going to do this today is similar to what we do in the past. So we do a little bit of an overview on the markets and see what's happening. The reason why I do that is to explain why, how markets are correlated and why one thing affects another thing. So if you're watching the news and you see something happens, you can kind of understand from that what it might affect or what it might not affect. Of course, we're going to do a general overview at the start with then a focus on commodities. So let's do this. Thank you, everybody, for a good evening, everybody. Thank you for joining us. Thank you for joining us just in case. My name is Walid Koudmani, market analyst of XTB. And yeah, let's get this started. This is a very important episode. I think some of you may be familiar with what's happening today, both in the OPEC meeting that just occurred earlier, and we have the Fed speech, so Powell right now. So let's just start and let's get talking. So some top news this week is that bond yields remain in focus after a volatile week that we've had in the past few weeks. The strong U.S. durable orders, so macro reports tend to be a main focus of markets, in particular indices, but also other commodities. So the strong U.S. durable order report overshadowed Powell's speech, driving 10-year yield to 155%. On Friday morning. This is last Friday. The yield is down to 141. This was at the beginning of the week after the RBA intervention pushed the Australian dollar 10-year yield down by more than 30 points. This is important because the more yields rise, they tend to overshadow other inflation coverages, meaning that people tend to invest in these yields, taking away money from gold, taking away money from stocks, and that is similar to what we are seeing right now at the moment. So gold, of course, dropped below the key 1765 support. That was holding for a long time, and then we saw it continue to drop. We had some positive data, which also probably doesn't help gold at this point, which is the stronger Japanese PMI, the weaker in China at the very start of intensive week. And this week we had some labor market data from the US in particular, and we have a main event tomorrow of the NFP. So a lot to talk about, a lot to cover. Tomorrow is the NFP. Today we had OPEC meeting. We had the inventory reports. We had the ADP report yesterday for the employment. A lot of macro events happening in these few days. Powell signaled in his last speech, so he's actually doing one now, but he signaled in his last one that at least 3 years is the message that he intended to send to the markets, meaning that the QE and the fiscal and monetary stimulus, one way or another, will be ongoing throughout the recovery. And time over time, as we'll go and see, the discussion was over the fact that it's not happening as fast as they assumed. So meaning that they thought that they could start tapering it now, but in fact, they are going to be leaving it a little bit longer. Next, we have why is important the jump in the U.S. yields, as I mentioned earlier. So why yields rise? I want to give you a little bit of background. Markets expect inflation to accelerate. So that's the rising cost of living, you want to say, or the value of the currency and what it can buy in an economy. For example, £1 today is worth way less than a pound, 10 years ago, than 20 years ago, and 50 years ago. That's inflation in a way. In spite of record QE and a lot of cash, and obviously QE and more cash injections into the economy tend to devalue, in normal situations, they tend to devalue the currency, meaning that inflation in a way is rising. But in spite of record QE and a lot of cash, the US Treasury still needs to borrow at least $1 trillion on the market. And we are having something called a convexity hedge, which is an increase in yields caused duration to shorten on mortgage securities market. Why is this important? Because the increase in yields from around 0.55%, which is last year's low, to 1.4%, which is the current, or what was the current, lower model valuation of US stocks by around 20%. Of course, other factors like expectations also play a role, meaning that it is used as a cover for inflation. So certain things are expected to rise year on year from most investors, as gold, is long term is expected to rise by most people. US stocks are expected, that's why they're safe investments for people, and that's why most traders trade those. But at the same time, when yields are giving you 1.4%, and on average inflation is around between 1 to 2%, that means that just with the yields of buying bonds, you are actually covering inflation, meaning that your money is not really losing value. And so that's why a lot of people are taking the safer approach into investing in yields rather than investing in stocks or the typical safe haven assets like gold, silver, any precious metal, really, yen, all these kind of off value assets. We also have the fact that yields are an important factor for the FX market, as I just mentioned, and increase in US yields has negative impact on the gold market in the short term, just because of what I just mentioned. But Powell lived up to his job last time, so let's see what he does today, of keeping a bull market alive. This is a chart on the X station where you can see the US 500 on the 15-minute time frame. The US 500 is the S&P, of course. So Powell managed to maintain positive market moves during his 2-day testimony in Congress. So you see the first testimony is here on the orange circle. And then the markets receive this boost. Then they start to dip a little bit towards this area here. And then second speech, and they get the second boost, raising it above any other resistance that was in the way at the moment on the short time frame, of course. Powell said that interest rates will not be hiked until full employment is reached and inflation overshoots target for some period. Hello, everybody. Thank you for joining us, everybody. Thank you. I'd like to welcome everybody, but thank you for joining us. And you didn't miss much so far if you joined, but we're just getting started, and we're going over a bit of a recap in what's happening in the markets, and then the focus on the commodities as we go forward. He added that inflation, this is Powell, he added that inflation may not reach goal for another 3 years. So assuming their inflation goal is 2% or something like that, then it might not reach that goal for 2 years. But what if the labor markets remains weak and inflation overshoots the target? This is a possible scenario, but the Fed did not address it. And this was what we've seen, is that every time Powell is asked about inflation or interest rates or adjusting, he always says, we'll see, we'll wait and see, we'll wait and see. So in a way that is optimistic for markets, but at the same time, the uncertainty is starting to grow and people are looking for safer ways to cover themselves. As you can see, it can be seen as kind of, but this is like similar to what Trump used to do, where he would, maybe even before the weekend, he would say something that was clearly meant to raise the stock markets, and that would give it a boost going into the weekend, or the other way around. And it's nothing new here, but central bankers tend to do that with their policy because their words mean a lot when it comes to the economy, obviously. But when Trump did it, at the time we were doing webinars, we were doing videos, and I kept discussing how every macro report from the US was pointing negative. We had 60 million unemployment claims up until that point, and the indices were still going up. So this is similar to what was happening at the time, but this is more like continuation of the QE and the market, let's say, liquidity conditions that we have at the moment, with low interest rates to favor the recovery. The debt market, though, knows better. While Powell may keep equity bull market alive, which is the S&P, debt market has seen just a temporary reaching. Yields resume upward move later on. So red is the gold. So the actual chart is the gold, while the blue superimposed chart, this is a feature on the X station, you can have multiple charts at once, is the US T-note. So you can see that gold is falling, but also the US T-note is falling. And these are the bonds, and as they fall, generally the yield rises. Impact of rising yields, limited so far, can be seen on the gold market. FX and indices do not seem to care. Fed is walking a tightrope. Accommodative policy may help maintain bull market as long as inflation does not rise. Because as I said, if inflation does rise, then the actual benefit of introducing cash into the economy is lost, because you can introduce $1,000, but if things that cost, let's say $1,000 per person checks or you want to do a QE to economy, to businesses. But if the dollar value starts to decrease significantly, then you're going to have to start doing it more and more, meaning that it's just a cycle that repeats, where the more money you introduce, the lower value it gets, the more of it you need to buy the same things. So for example, a loaf of bread could cost $1 today, $2 tomorrow. That means tomorrow you have to print 2 to support the economy rather than 1, increasing the supply. If you go and look at the, we don't have this in this charts that I'm showing you, but if you go and look at the cash printed by the US within the last 100 years, you'll see that there's a huge spike in 2020 where it was like a curve, and then it just spiked last year, of course, unprecedented conditions, let's say, but this all has to eventually probably have some sort of an impact. What we're seeing right now is some sort of inflation coverage because people expect all this money that came into the economy to devalue the actual currency. The Fed is walking a tightrope, as I said, and on the other hand, if we see a pickup in inflation, the Fed's credibility may be seriously undermined, and we may see some panic reaction from the central bank, whether it is higher increasing interest rates or some sort of other measure that they might take to counter the rise in inflation. We had, of course, as the yields increase, the risk of gold falling increases as well. As I mentioned earlier, they are tied in a way to cover inflation. Yields are key for equities, though, and we can see that with these two charts from Bloomberg. So this one's from Bloomberg, this one's from DataStream. Higher yields equal lower valuations. Rising yields and PE led to crashes in 1987 and 2000. So you can see that the 1987 crash here is this is the S&P, and this is the yield. And you can see the yield increases, and then the crash happens. The yield increases, and then the crash happened, the dot-com bubble. Of course, these were related to other things as well, but the economy tends to function as a whole. In a way, things tend to catch up with each other. So you'll see that something similar, for example, is not happened here yet, and it remains to be seen if it will. Maybe the Fed will correct some sort of action, or they will be able to avoid this happening. But in general, of course, as you know, historical data does not guarantee future performance, but we look at history for an indication of what might or may not happen. And on the left, we have on this chart, bonds were very oversold, so some kind of normalization was natural. The reflation trade is far from over, though, as you can see. JP Morgan Global Bond Index, at the top, way oversold. At the bottom, overbought. Or rather, overbought, oversold. Let's move on to FX and the US dollar, which is the currency in which most commodities are quoted, including oil, gold, silver, platinum, I think copper as well. Most world commodities are traded in gold, are traded in US dollar, so that's why we are going to be covering the US dollar at the moment. Plus, it's tied to what we were talking about before and what's happening at the moment with the Fed. So let's take a look at the USDJPY, so the US dollar yen. We can see that the increase in relative interest rates should support the given currency. It can be seen in the case of USDJPY, so the USD yen. USD yields, or US yields, the white line here, rise faster than Japanese yields, which are the yellow line. As a result, spread is increasing, pushing FX rate higher. So this is the spread, the green line, between the two bonds, and it is pushing USD higher. On the Euro USD, though, which is the most popular currency pair, this is not the case because German yields are rising, as you can see from this top side, albeit slower than US, and they remain negative. We can see Euro USD heading in different direction than yield spread. So you can see the yield spread is actually going down while Euro USD is going up. The dollar had been weakening. The euro is actually strengthening against a lot of other currencies. The central bank's decisions have been positive for the economies. Plus, we have seen a lot of reopening from the European economies. When it comes to the US economies, in fact, or the US economy, we have seen a lot of negative data, and they were one of the worst hits from the pandemic. So as you can expect, the recovery is going to be a little bit slower than perhaps in other countries like Australia, New Zealand, and even Europe. Hopefully everything is clear so far. If you have any questions, of course, that's why we're here. So if you have any questions, feel free to ask them. I'll try to get to them at the end. After all of this, I'll be more than happy to go through a Q&A section with anybody here who would like to ask any questions, whether it's regarding this, what I'm talking about right now, or the commodities that we're going to be talking about later, or just trading in general, these events are done for you. So if you have any questions, please feel free to either write them down and save them, or please feel free to save them until the end Q&A section that we're going to do. But first of all, why is USD lagging? It is still expensive. Out of all the G10 currencies, USD trades at the highest level compared to the 20-year average. You can see here on this chart by Macrobond that the USD is actually on the 20-year average, which is this black line, is the highest level since 1998 and even higher. Markets may be afraid that the Fed will not react and higher US yields will be offset by higher inflation. There may be other reasons as well. USD is short is a very popular trade, and institutions may try to profit from it as much as possible because most institutions and most traders, let's say, tend to try to go against the current, the main, let's say, if USD is going up, a lot of people try to get the short so they can get profits from the way down. They will capitulate only if a real trigger surfaces. So if increases in US yields is not enough, a correction on equity markets could be needed. However, stock market does not seem to care about yields so far, as we've seen. And even today, with the DAX and the US indices are slightly pulling back because of the yields, but at the same time, nothing like what we've seen in gold. So far, USD index is trying to defend the key 90 support. We're going to take a look at that at the end. But in spite of recent weakening, USD is not cheap. It has only erased pandemic bounce. But there is a special case, which is the pound dollar, so cable. On the cable side, we have discussed it a few weeks ago, in fact, after the Bank of England decision. Spread is rising slower than the FX rate, or at least it is not declining, as is the case for the other. Market positions for quick reopening of UK economy. The pound is still cheap in long-term perspective, in short, overbought, but still with potential. Why is this? Because if you look at the long-term perspective in the past, the pound was actually at $2 at one point, and then started dropping to a low of around 115 when at the height of the, let's say, the panic of between the pandemic and the fact that it seemed like Brexit was going to be a no-deal situation. Both these things dropped massively the pound, which saw a drop to 115, as I'm saying. People were speculating that it might even reach parity, so 1-to-1 with the dollar, but of course that didn't happen. We saw the huge recovery with the pound managing to break over 140, 141, even in just the recent weeks. In that case, of course, as we said, that the dollar is overvalued or stronger than it was in the last 20 years, and the pound is actually undervalued compared to the last, I'd say, few years for sure. Calendar this week. So as I mentioned at the start, there are some key events to keep an eye on. Of course, most of them have passed, but there is still one major event tomorrow. So let's talk about it. The US labor market data is in focus. We had the ADP report the other day, and we have the NFP report tomorrow. When it comes to macroeconomic data, market attention will focus on reports from the US labor market, mainly the ADP, which is the private one, and the NFP, which is the government one, non-farm payroll report. Strong data may pressure the Fed to start to talk about bond tapering, which could support US 10-year yields, dollar, and put additional pressure on precious metals. The problem with the NFP is that growth had stalled well ahead of the previous peak. So let's take a look here at the US NFP. So we can see here that these are basically year by year. So this is January of every year. And you can see that last year, there was a huge drop. And in fact, even now, it is lower than the previous years before that, which is strange because you would think that with all this room to recover, the NFP should be showing these huge gains in the job market. But in fact, what we're seeing is a stabilization and in fact let's say a standstill on the growth of jobs created in the US. And this is very important because people used to be able to let's say the ADP report on Wednesdays. So let's assume that Wednesday is the report, Friday is the NFP. People used to look at the ADP report and think that it is a good indication of what might happen in the NFP. So if the ADP is very positive, the NFP will likely be positive. At the moment, that's not the case, because we've seen several times where the ADP might be showing one thing, then the NFP will show something else, and that's really dependent on where these basically these predictions are being made. Because if they're being made based on what the expectation for the NFP alone is, then that's one thing. But if they're being made based on the economy and how you can see the whole area level of the economy happening, you have to take a look at the economy as the bigger picture, not just the NFP, not just the ADP, because as I'll mention in a minute, you'll be able to see that there are other indicators that show you that the economy is not doing well. So therefore, you cannot expect the huge bounce in the NFP or any other. I'm not saying that tomorrow we couldn't see one, but for example, the ADP was already slightly disappointing, and we're going to be waiting for tomorrow's NFP as well, which will surely affect markets in some way. The problem, as I said, with the NFP is that growth had stalled well ahead of the previous peak. The ISM, manufacturing and service indices, are these are the ones that I was kind of mentioning. ISM manufacturing and ISM services PMI are the indicators of prices. So due to rising concerns regarding inflation, the market will be looking at cost sub-indices. And this is because they show you the perspective of the consumer. Generally speaking, if prices rise, if certain things are happening in the economy, they can give you an indication of the overall health of the economy. As you can see, this is year by year again, huge crash in 2020, and then a rebound in 2021 towards the end of 2020. Now, for the main event of today, and why I'm sure many of you are here, let's talk about commodities. And we're going to talk about a few, and then if you have any more questions, we're going to be covering whatever you want to cover. When it comes to commodities, I have the X station ready to go, so we can just do a Q&A on commodities after that. But let's get through a few things. I already covered a little bit of gold and what's happening with gold, why it's happening, you know, with the yields and with the markets still recovering slightly. But let's take a look at some charts, and let's take a look at some technical analysis mainly, let's say. So on this side, we have a chart on the X station showing the price of gold on the daily chart. You can see that it's kind of trending downwards from August 2020, ever since it reached above $2,000. And it's been trending downwards, touching this lower level several times. Now, as I said, let's start today. Looking at the daily interval, we can see that the price of this commodity has been trading in a downward channel. Buyers appeared on the lower limit of the aforementioned channel yesterday. So this is a few days ago now. But the main sentiment remains bearish, because if you look at the basically now we're 8 months in, or from August, it has been going lower. The top side has been tested only once, while the bottom side has been tested twice or 3 times, counting the first time. So that means that sentiment remains bearish. Should the fall continue, the $16.90 area could be the next key support to watch, because it is, as you can see, the lower limit of this, plus also close to the Fibonacci level, which I will mention in a second. There's a couple of Fibonacci levels that are key, so we'll talk about them. On the other hand, should buyers become more active, the nearest resistance to watch lies in the 1773 area, which is marked by the previous price reactions and the 50% Fibonacci level. So if you can see on this chart, and hopefully this is all clear, but basically you can see that the general direction in the long term seems to be downwards, even though before that is upwards. So after it starts going downwards, it tests the lower limit 3 times, meaning that this could be a potential support to keep an eye on. And if you look at this level in particular, it intersects with the 61.8% Fibonacci retracement level of the upward move, which is an important level. Meanwhile, if it does go back up, what I was just saying is that the level to keep an eye on could be this level here, where you can see price reactions on the daily chart on all 3 levels here, around here as well in the past, and it is the 50% of the Fibonacci retracement, so halfway down from the upward move. Main event of today, we saw oil. So I have some news for you for the oil OPEC meeting today, but let's talk about this, and then I'll mention the news that we've gotten just recently, actually just a few minutes ago. Oil dropped ahead of the OPEC meeting on the future of output cuts. Saudi Arabia wants the gradual restart of production, while Russia wants to bring back production more quickly. OPEC cut in March is expected to be of 7 million barrels, 7.05 million barrels per day, while it was 7.125 million barrels in February. Decisions on the future outlook will be key. And in fact, if you're looking at the chart right now, not this one, but the one on the X station, you'll be able to see that price jumped, and we'll talk about that in a second. Iranian exports are expected to continue to be pressured by the United States, which is surprising considering Biden was supposed to go back into the Iran deal, which was potentially, as we talked about in the past in the previous video, was supposed to bring back production of oil, potentially dropping prices. But in fact, it seems like there's still hostilities between the two countries. Exports dropped from a 21-month high in February. Venezuelan imports dropped below 0.5 million barrels per day, almost 2 times lower than a year ago. Of course, the Venezuelan economy has been one of the hardest hit by the pandemic, but also by several sanctions that we have seen. Goldman Sachs expects Brent to average $55 and WTI to average $52 in 2021. Now, if we're going to look at the chart, but however, Q2 forecast of $70 for Brent has been maintained. The current deficit on the market resulting from low OPEC production may be as high as 2 million barrels per day. Now, before we talk about the OPEC meeting in particular, let's talk about this chart on the right-hand side. Well, this is the seasonality, this is the RSI, so relative seasonal trends, relative strength index, and then a daily chart of oil. This is Brent. So there were 3 upward waves during the 2016-2018 boom on the oil market. You can see 1, 2, and 3. Each was $25 on average and was followed by $10 to $12 decline, which is something a lot of people don't seem to pay attention to, let's say, which is the fact that nothing goes in a straight line forever. Sometimes things need to retrace and then they continue, or sometimes it could be a retracement and then a pullback. But as you can see, 3 times in a row, usually at a gain of $25 with a pullback of $12, so about half. Situation continued until a large price decline in 2018. First upward impulse from 2020 was very similar to this pattern, as you can see for 1, 2. But of course, we had a situation of the pandemic here, of course, with the drop. And now we have this slight recovery towards the end. Current seasonal patterns hint at a possible pullback toward the $55 area. This is Brent, of course. Upper limit of the upward channel should act as a resistance. Q2 target remains price zone above $70 and long-term downward trend line. This is why analysts and people tend to mix fundamental and technical analysis. Because if we look at this side, it's all mainly fundamental, let's say. So it's news regarding production, supply and demand, all these things that affect, obviously, the price. Because if there's no production, obviously there's no price when it comes to commodities. That's why I like to think about commodities in that way, because it's very easy for me to relate and understand that, okay, let's say oil production mainly happens in the Middle East when it comes to Brent, or they're one of the main producers. So you can expect perhaps that some instability in the region could affect oil prices. So these kind of correlations are more simple for me to understand, and then that can kind of build the knowledge from there. And that's why, but then when you mix it with technical analysis and we take a look at these charts and calculations, we can see that sometimes patterns tend to repeat. So you can see that in 3 areas, and this is over the course of years. So over the course of 2 years, these things happened one after the other. And this is the similar situation, but this is a course of around 2 years at the moment as well. About 1.5 years, actually. So we take a look also at the upward trend line, which is touching several levels. Didn't manage to touch here, but if we take a look at this upward trend line, this area around $70 is a resistance here. It's a resistance here. Price reaction area, and then the price actually rebounded downwards from there. So these are the areas to keep an eye out when it comes to oil. Of course, this is before the meeting of today. So let's take a look one more time. Last but not least, let's take a look at this oil, the WTI market. Taking a look at the commodity from a broader perspective, one can spot that the price reached a long-term resistance at $64, where sellers appeared here on the weekly. This is in 2018. Where, of course, the main sentiment remains bullish, but the risk of downward correction is high. Considering such a scenario, the nearest support to watch can be found at the lower limit of the 1-to-1 structure, which is basically 1-to-1, and meaning that if there's let's say a 50 point drop, or let's say $10 drop, that'll be a $10 increase at some point, 1-to-1, like a symmetrical pattern, let's say. On the other hand, if buyers manage to break the above aforementioned $64 resistance, the way towards 75.3 will be left open, because as you can see, 1, 2 potentially resistance points, and then after that you have to go to the high from 2018 to actually find the next one. Around here as well could be considered, but really this is the main one, as it would be the long term, but this area in general could be considered the long-term resistance. Now, before we continue, actually, let's talk about the news of the OPEC meeting. I have it written down here with me. So the predictions were that basically oil was actually the production was going to increase because, as I mentioned earlier, Russia wanted to increase production. Saudi Arabia had asked to keep production the way it was, but on top of the OPEC agreed cuts, Saudi Arabia had agreed to do a 1 million barrel per day voluntary cut on the market in order to boost prices additionally. So that is also going to be staying. That is the news today. We have the production cut from Saudi Arabia is staying. We have slight increase from Russia. I think 50,000 barrels per day increase. We have a slight increase from a few other countries, but overall the production cuts are staying. And now let's do it at the end, but basically if you take a look at oil, the price jumped right after the decision. We're going to take a look at it after these last few slides when we do the Q&A section. But when it comes to the news from today, it is a surprise. Plus, along with the continued tension between Iran and the US, we are seeing that oil prices are not being pressured as much as we thought they would be with the production increases. Plus, the positive rate of the recovery in the economy is also helping oil prices, as they were very tied to those, because if there's no transportation, there's no demand for oil, whether it's flying or with jet fuel or gasoline for cars or any sort of demand for oil is tied to also transportation. Moving on to copper. Copper, important metal, not very covered, although I tend to cover it in the webinars and the videos that we do. Very important because if you know the fact that copper, 50% of global copper imports are imported by China. So let's say 50% of global copper production goes to China, meaning that whatever is happening in China is going to probably have a huge impact on the price of copper. Copper prices dropped around 6% since February to around $9,500 per ton. Seasonal patterns hint at a possible downward move until mid-April. US seasonal patterns, obviously, as I mentioned, or maybe I haven't mentioned, but basically seasonal patterns, what they do is they indicate periods of rise in demand and supply, or rise in prices based on previous, basically based on the history that we have. USD strength can be named as a reason behind recent copper weakness, as I said, because since most commodities are quoted in US dollar, the stronger the US dollar, sometimes it tends to negatively affect the price of commodities. Since, let's say, how can I say this? Let's say you want to buy 1 ton of copper for $9,500 today. Tomorrow, or like a month from now, the dollar increases in value, meaning that 1 ton you can buy for $9,000 in this example, but the $9,000 is still worth as much as $9,500. You know, like the copper is worth $9,500, but the $9,000 are now worth $9,500, if that makes any sense. So, but you're getting less money for the copper, which means that the stronger the currency is, the less of it you're getting per ton of copper or per ounce of gold or per commodity that you're trading. Copper to gold ratio jumped above 5. The ratio sat slightly above 6.5 during a peak in 2009. And we can see that continued rise could suggest continuation in the rise of US yields. On the other hand, an abrupt drop in the US yields could be a risk for copper prices. Current copper pullback can be reasoned not only with USD strength, but also increase in stockpiles on global exchanges, especially in Shanghai. Let's take a look at this. So Shanghai Future Exchange's weekly copper delivery stocks. This is the green line on this Bloomberg chart right here. You can see 2021, so December. Actually, let's take a look. So March of last year, so the pandemic starts, and you see this huge dip in copper supplies in Shanghai in the exchange, which is, let's say, the main one in the world. But then from June, you start to see this slight rebound leading into September, and then a pullback into the end of the year, and then now a recovery, which is actually, this is an increase in supply on the markets, meaning that the price is now being pressured because of it. And if we look at this, the yellow line is copper. Copper and credit impulse in China. So lack of credit expansion in China may pose a threat for copper prices in short or medium term. Credit impulse growth slowed significantly and differs from the 2010-2011 situation. On the other hand, recovery in China, credit impulse should be positive for copper, really mainly related to what I was just talking about right now, where since China is one of the main importers of copper in the world, if not the main, the more credit there is in China, meaning the more money that circulates in the economy, the more potentially copper will be imported. But this is the case for any metal, but now we're using the example of copper because it is very relevant to China in this case. Next, another commodity, cocoa. Cocoa prices jumped significantly last week. Price tests upper limit of trading range at $2,700 per ton. Interestingly, expiring March contracts trades $100 higher, hinting at a strong short-term demand for cocoa. But however, future curve shows limited backwardation of $20 over the 1.5-year horizon. The net speculative positioning for cocoa is more or less neutral. That means the amount of long positions versus short positions. So let's say in the markets, in most markets, even on the X station, you can see how many people are long and how many people are short on certain markets. And this really goes into the RSI as well. And this is related to how the perception of the economy is for certain good or service or commodity in this case. So if most people are long, then that means most people believe it will continue to go up. If most people are short, it means that even if it is continuing to go up, let's say the price is going up, but most people are short, that means that most people expect it at any time to drop, but it could continue to go up. Now at the moment is a little bit more unclear because on cocoa in particular, the net positioning is quite neutral, meaning that it could be a 50-50-ish going up or down a few percentage points. But March has been a poor month for cocoa prices over the past 10 years. Big declines from March last year. However, as I said, big declines from March last year, which is the pandemic, distort the average. And this is the Bloomberg chart that can show us the 10-year average from 2021 to 2013. You can see that a very negative month tends to be not just March. In fact, December seems to be like the worst one. But if you look at the percentages that are being lost, so it's 18.5, 12.9 in 2015, 21.43. So these three, and in particular this one, tends to distort the average for March because, as you can see, most of the time it's actually green when we compare it to these other months. So it doesn't mean that every month, every March is actually going to be negative. It just means that a few of the big times that it was negative was in March, and last year there was a special cause for that. So it's not for sure that this year is going to be the same, which is why obviously this disclaimer is very accurate in this case. On the other hand, as I said, April is usually a positive month for cocoa. So you can see April, we don't have it for this year yet, but we do have the 10-year average, and every other year besides 2017 is actually positive in April for cocoa prices. Cocoa prices test the upper limit of a recent trading range. $2,700 area is the first resistance here on this chart, you can see. And while 2,900 is the next. In case we see a pullback, the lower limit of the upward channel could be the first as support, as here, right down on this side. One more commodity, and then we'll do the Q&A section. So I hope you've been holding your questions because I'm excited to answer a few of them for sure. Wheat has experienced much smaller volatility than corn or soybean. Wheat prices do not react as they did in 2007 or 2010-11. Global fundamentals for wheat remain negative. This is generally due to, could be quality of wheat, that is a quality of corn. These are very important factors to keep in mind, but also it could be weather conditions. So we had this huge storm in the US where temperatures were absolutely freezing, huge damage, power lost, and this all tends to have an effect on commodities, obviously, in case, as you saw, oil production was actually stopped in several Texas facilities because of the weather conditions, and this is very important to keep an eye out when it comes to even commodities like wheat or corn or anything that gets grown basically and is reliant on the weather. Positioning data does not show a pressure neither from buyers nor seller, similar situation to cocoa. Nevertheless, in case costs continue to rise, so oil, when it comes to these kinds of commodities, there is obviously associated costs with transportation and or alternative crops. Wheat prices may continue to rise in case there are small costs, because the costs then get forwarded onto the consumer usually. There's also here a small backwardation over 1.5-year horizon. On this chart, we have the world wheat price versus the stocks, and the wheat price versus the production consumption spread, and the wheat price versus stocks to use. Global end stocks are declining while the production and consumption are nearing an equilibrium. Stocks to use remain at a very high level compared to history, which tends to have a increased pressure on the commodity market, and in particular wheat in this case, because we're talking about the supplies that are available. Finally, we have this chart from Bloomberg, this chart from the X station. No pressure can be spotted in positioning data, neither from buyers nor sellers. As you can see here, Bloomberg future positions around this area here, so it's not high nor low. The futures, long and short, as you can see, they're very close. So it's not like the long. These would be the short. The yellow line would be the short positions, while the white line would be the long positions on futures. And so you can see that historically, it seems like there are more short positions, unless in these situations there were more long positions. But now there are more long positions slightly, but you can see that they're quite. The spread is quite tight. On this other chart, we have the 1 week future versus the non-commercial future positions. Wheat prices performed in 2016-21 similarly to 2002-2006. This is a monthly chart. Slow uptrend with limited volatility. Assuming a similar situation, the current correction could lead to highs from previous trading range, the 576 cents per bushel area, or have a similar range to correction from 2006, leading to 540 cents per bushel. However, in case global stocks do decline, price could reach as high as 1,000 per bushel, which is, of course, this area around here, the highs from 2012. And I think that's it for the slides. So hopefully this presentation was useful. We did end up covering a lot more than just commodities, but I do try to tie in everything together to give you a sense of why it's important to pay attention to news in the markets and certain things, why they have effects on others. So thank you for watching. If you have any questions, I would be more than happy now to do a brief Q&A section. What time is it? Yeah, about like a 15-minute Q&A section. So I have access to the comments right here on YouTube. If you'd like to ask any questions, please feel free to write them in the comments. And I can even pull up the charts. I can pull up the X station and we can check out some charts if you'd like. We didn't really talk about silver. Silver we talked about a lot more last webinar in the VIP Trading Club we did with clients. But silver's situation is similar to gold, except that silver tends to have more practical uses, and therefore the demand for silver can be more influenced by what is happening in the economies. So let's take a look. Yes. If anybody has a question, please feel free to ask. Hello, everybody. I just saw the hellos. Thank you. Good evening. Thank you for being with us. Of course, if you'd like a recording, you'll be able to find this on YouTube. And if not, you can just contact your account manager. If you'd like to join the WhatsApp group where I send notifications, news, and updates and analysis on the WhatsApp groups throughout the day, you can feel free to contact your account manager and they'll be more than happy to add you. Now, let's take a look, actually, while we wait for the Q&A section. Let's take a look at oil. So this is a graph of Brent with WTI, but let's actually just go to each one individually. Here it is. Oil D1. Let's take away the WTI. Look at this jump. You can see that after the meeting that we were just talking about, this is on the 30-minute time frame. So the OPEC meeting started at 3. So we have a small pullback before the meeting, 1%, and then this huge jump of 4.5% on Brent to reach 67.73. And then we are seeing a slight pullback on the 30-minute time frame at the moment, with oil trading around 66.62. Let's take a look at the past, and let's draw another line. Let's Let's make it orange. So let's take a look. Actually, let's go back on the time frame. You can see this area that's being tested right now corresponds with this area, which acted as a resistance in the past. This is important because areas that act as resistance when they are overtaken, they sometimes act as support. So if this price can actually break through it, it could actually continue heading lower or not. It could be just a slight pullback, but this candle is pulling back at the moment, and this level might be able to actually hold. On WTI, let's take a look at WTI. This is similar situation, but not as big of a... Oh, wait, hold on. Let's see. Similar situation. As you can see, the slight pullback. This one, although it was 1% on Brent, 1.3%, and then 4.6, 4.7% increase for WTI, which is very interesting considering less than a year ago, WTI contracts went into negative prices. So let's take a look. I see yes, Philip asked, can you do a recap on gold? I can do that in a second. And Kana asks, do you trade more than commodities, and do you use the same analysis across all commodities? Okay, good questions. Let's start with the second one, since I can answer it without having to open a chart. Yes, you can trade more than one commodity. You don't have to trade just oil or gold. I just find it a little bit easier to correlate commodities with supply and demand. So like, if I know what factors affect supply and demand for a commodity, then already I'm doing a lot of the analysis by doing that. So if I know that, for example, oil production is this much and the price is this much, let's say oil production before the extension of the cuts was a certain number and the price was around here, meaning that producers and suppliers and consumers at that point have agreed that this seems to be the price for oil at that production. Now, if production increases, normally in the laws of supply and demand, but this is not, of course, how everything works all the time, usually you would expect the more supply there is, with demand being equal, price could go down. That's just the basics of how I think about commodities, and then everything else is on top of it. So what I do when it comes to technical analysis, there are certain indicators that maybe I like more on commodities. Like I like the Ichimoku. You can see that it tends to give me an idea roughly at first glance of what's happening. I like to draw trend lines. I like to do support resistance levels, but you can do that for any market. It doesn't have to be commodities only. It's just that commodities are easy for me to wrap my head around when it comes to supply and demand. While with stocks and with other indices or with other things, usually you have to pay attention to the reports from the companies, their earnings reports, what's happening in the economy as a whole, which also applies to this. So in essence, I don't use exactly the same analysis because they wouldn't be able to apply. So of course, as we mentioned in these slides, as I'll show you again. Yes, on the wheat. So we have wheat, obviously, as I mentioned, fundamentals for wheat remain negative, which could be weather, could be quality of the wheat. That's not going to be applying that much to oil. To oil, fundamentals could be, like you see, Saudi Arabia, Russia production, Iran tensions. These are the things that affect oil when it comes to fundamental level. Venezuela, these are the producing countries. I would say that if you're trading a commodity, a really important thing to do is realize where that commodity comes from, mostly, because you'll be able to follow news of that place in particular. So for example, as I said earlier in the webinar, I said that if oil, like if you're following oil and you see some sort of instability in the Middle East, your mind will immediately jump to this could have an impact on the price of oil, because historically, you know that oil is produced in those countries, not only, but you'll know that a huge part of the production is in those countries. So anything that affects the supply coming from those countries could then impact the price as on a global scale. Hopefully that answers the question on the commodity trading and the commodity analysis. Let's do a quick recap on gold as well. What do we have on gold? On gold, we have this chart right here, where we can just see actually in real time gold breaking below $1,700, as you can see, and now currently trading at $16.94 on the hourly time frame. Where do we have to go and find this level? We have to go this far back which is June 2020. Right? Yes, June 2020. Let's go on the daily. This might be easier. So we are now at the lowest level in, I'd say, 8 months on the price of gold. You can see that this downward move that we were speaking of, sorry for all the levels, but this downward move that we were speaking of has halted a few times with some recoveries. As you can see, drop and then recovery, drop and then recovery. And it's actually the opposite of what we were seeing on the charts last time. What we saw on the charts in the upward move was an increase of $25 on the oil price of oil, and then a pullback of 12 and an increase. While here on the price of gold, we're seeing the opposite, where a decrease and then a small pullback, and then a decrease and then another small pullback. And now the final major, let's say, support psychological level was 1700, but really the main one we spoke of earlier was 1695, which at the moment seems to be holding. But this is in real time as we speak, so again, things could change. But based on the analysis we actually did earlier in the video with the slides, this was the level we mentioned that could be a key level to keep an eye on, the 1695, because it is at the lower limit, and we can do some trend lines as well. But I like to do them. Let's do them like this. And then we can set it maybe on this side and see if it touches anything. So as you can see, it actually touches a few levels and it ends up being on this 1695 area. We can actually extend it and take it even further up. But for the time being, let's keep an eye out for gold at this level. And yeah, this is very important, actually. This is interesting that it's happening live as we speak. But today and tomorrow, especially with the Fed, with the bond yields, gold is going to be a key market. Said we discussed silver. Silver, similar situation. Of course, silver had the jump because of Reddit investors not that long ago. But now, huge dip, probably following the price of gold, around 4%, because gold and silver are not exactly the same in the sense that gold has less practical uses, meaning that any sort of demand for gold, or most of the demand for gold, is going to be based on ETFs, jewelry, safe haven, so basically a store of value. And while silver has a lot of practical applications, I've spoken about this many times, how many uses silver has, especially moving forward. Silver is used in many industrial projects, plus it is used in electric batteries and electric vehicle batteries, which are main focus of the economy moving forward. So whether it's with Biden and his plans to make a green economy, or European markets and European economies with their plans to increase their green energy output. So that's all going to lead into more production of batteries, which could lead into a demand probably of silver, unless there's other metals as well, but silver is one of the main ones that's used. Connor asks, thanks for the answers. Yeah, that helps. I'm mostly learning effects and using technical analysis. So I was wondering how things would translate. Fundamental seems to make more sense for commodities. Yeah, it's really a mix of both. And I like both. I used to like fundamental analysis more, and then I started liking technical analysis a lot. You tend to see a lot of the same patterns. But fundamental, let's say, if you've ever watched the news, that's fundamental analysis on some degree. So if you ever watch the news and it says that something's happening somewhere, if you know that that country or that place or that, that in particular has an effect, or they produce something in particular that maybe you're trading, then whatever it might be, you might not even know that it could affect it negatively or positively. But if you just go and take a look at the chart, practice that, maybe like follow some news that interests you about a market that interests you. It could be a commodity, it could be a commodity, it could be an index, it could be a forex pair, it could be anything you want. But at the same time, follow the news that is related to that. So for example, tomorrow there's the NFP. If you're a trader for the US indices, just take a look at what happens when the NFP is announced. We're going to be covering it, of course, here at XTB in the analysis section, in the news section, and on WhatsApp as well. So you don't have to do all the work yourself. But at the same time, it is good to know that certain things do affect certain markets. And that doesn't mean that you'll be able to predict every time. Like every time the NFP is positive, the gold price will go down, or vice versa. It just means that you'll be able to start relating in your head that certain things that happen in the world do have an effect on markets. At the same time, you have to take a look at the charts, because you can't just be opening trades based on the way you wake up in the morning. You have to be able to pinpoint areas that can be relevant. So for example, first glance, let's just keep this chart. I think most of you would be able to put like a resistance on this higher area. So always let's put a resistance, let's say at the very top, and then let's put a support at the very bottom. So at the moment we would be at 25. Some important areas we could see, let's say any area which you can see a lot of price resistance or price reactions. So let's say this area here around $27. And if you notice, I'm actually looking at the area, at the candles, and then I look at the price. But then it's a funny coincidence that you notice usually where, okay, I'm looking at the candles and I put it based on the candles, but then I look at the price and it's almost exactly $27. So these psychological levels tend to be very important as well. And this is more tied into trading psychology and risk management. But it is really interesting when you notice technical analysis. And I didn't even do anything fundamental right there. I just put a line where I saw a lot of price movement, and it turns out to be at $27. Acted as a resistance here. Now let's put another one maybe here. 25-ish, 25.9, 26. Yeah, like lower limit of the Ichimoku cloud, lower limit of all these price reactions, and then a break in this candle breaking below 26, going all the way down to 25. Mix both of them, look at the news, look at the, obviously we have a news section here on the X station. You can find like, what I was just talking about right now. Oil prices rise after OPEC decision. So you'll be able to catch all these once you start paying attention. Of course, this is my job, so this is what I do. But I enjoy it. I used to watch the news even before I had this job, so I really enjoy just kind of relating things to each other. Yeah, exactly. Them dipping matches USD rising today. And actually, another thing that I like to do with, I don't know if this is technical or fundamental, really. It's a mix of both, I would say. But what I like to do is put two graphs on top of each other. So this is your USD on the hourly time frame with some RSI. But the important part is what I'm going to do now. So let's take away some of this mess. And let's make it a little bit bigger. EURUSD actually just broke below 120-ish. So key level, as you can see, held in the past. And we're actually approaching this area, 119.5. Due to the dollar strength, which we can see here. This is the heat map on the market analysis section. Everything on the left means that it is losing against the dollar. Everything on the right means that it's gaining against the dollar. Best currencies today seem to be the dollar, the euro, the pound, and even the Canadian dollar. But the dollar is actually gaining heavily against, 0.4% against the pound and 0.8% against the euro. But let's go back to what are we talking about. So if I want to take a look at this, and you can see there's moving averages, I want to add another chart. So I'll put the compare charts on the X station, and let's put the US dollar index. And you can see, so this US dollar index shows the performance of the dollar against a basket of currencies, in a sense, indicating the strength of the dollar. Now, what does this mean? You can see that the dollar increase is then correlated, and actually I'll pull it back. It is quite interesting to see how symmetrical sometimes it can be with the increase in the euro, with the decrease of the dollar. Why is this important? I think it's important because the way I see it is it helps me identify if the currency is moving because of its own strength or because of the weakness of the main pair that it is with. So let's say we were seeing dollar go up, but also the euro go up. That would then be definitely euro strength against the dollar. If we see the dollar go up against the euro dropping, it could be the euro is still stable, but the dollar is just gaining strength against, as we mentioned here, most other currencies. Sorry, the heat map, most other currencies. So having a couple of charts on top of each other, drawing some levels, just gives you an idea of what you're looking at. And then obviously all the news and the fundamentals come in as well on top of that. So thank you for asking that question. Hopefully that clarifies it a little bit. Any other questions? What time is it, actually? We're at 7 p.m. UK time. Let's do a few more. Let's do a couple more, and then we're going to call it a day. It can be about commodities. It can be about anything. So, yes, if you have any other questions, let's see. In the meantime, let's take a look at some charts while we wait for some more questions to come in. So we have DAX dropping below 1400. We saw the US 100 also dropping earlier to the lowest level since January. Let's go on the daily chart. Why not? Actually, let's go on the 4-hour. As you can see, now we're actually at the lowest level since December. Bombay asks, gold commodity traded on the X-Station platform is classified as a CFD. Yes, it is. It is a CFD, and I will show you here. Look, quotations of troy ounce gold on the interbank market. Okay, this is a chart that I have for my own viewing, which is all precious metals combined. The ones we offer, at least, or some of the ones we offer. So I have, it's a disaster to look at, but I just use it as an indication. Don't worry, I'll change it right now. Let's take a look at gold. So gold 1693 level crossed, but it's important to keep an eye out for the longer term. Yes, here, let's take a look. See commodity, as you can see, this is all the details you need to know. Swap points, the leverage you can have. So a leverage, obviously it's going to be a CFD, and this is the market sentiment at the moment. 56% of people are long, or rather are positive about gold, while 43.5% are negative about gold. So yes, it is a CFD. Any other questions? Let's do one more, and then we're going to close out this webinar. Thank you, everybody, obviously, who watched until now and paid attention, or found it useful in some way. I enjoy doing these, and if you have any topics, feel free to suggest them. If you'd like to join the XTB Market Alert on the WhatsApp groups, feel free to contact your account manager, and you'll be receiving news, updates, and analysis on a daily basis. Also, we do YouTube videos a couple of times a week, plus these webinars here and there. So we're just trying to, plus the news section, so we're just trying to give you as much content as possible so you can make the most informed decisions with your trading. Yes, let's take one more question, and then we're going to call it for today. So let's take a look. Anybody have a question, or should I just end this webinar right now? It's okay. Let's see. We did cover a lot of things today. If you have even any doubts, Philip, thanks again. No, it is not a Gibson Les Paul, but I wish it was. It is just like let's say a cheaper version of it with a Gibson Les Paul. I would get one eventually, but also I'm left-handed, so it's kind of challenging for me to find guitars that are stylistically what I like. Thank you, everybody. Thank you everybody who joined. If you have any more questions, again, let's do one more question. I am enjoying this, so I don't mind going on. If you have any more questions about commodities or trading or anything you want, please feel free to ask them right now. If not, then we can just end this webinar. As you can see, as we speak, gold bouncing back up above this level, 1695. Thank you, everybody. Thank you, everybody who's commenting, of course. Okay, let's just end it then. I think we've talked about enough topics for one day. I don't want to fill your head with too many things. Go on, and if you want to rewatch this video, it's going to be available on YouTube. If you can't find it, just contact your account manager. And you can expect more content from me, whether it's on WhatsApp or on the YouTube videos. And of course, we're always looking for, as I said, suggestions and just indications on to what kind of content you would be interested in having. Commodities are a huge topic nowadays, so that's why we decided to do a commodity special. But even in this commodity special, I like to cover what's happening in the economy so you know and follow what the news is. Thank you, everybody. I guess thank you, everybody, for being with us here today. My name is Walid Koudmani, market analyst for XTB. And yeah, I'll see you in the next video. Thank you very much for paying attention, and thank you very much. Good luck with your trading.